Hello, hello. My name is Ben Forman. I'm the founder of ParaFi. I'm humbled to be on stage today with both Lucas and Stani, who are really two of the pioneers of this industry, not only real-world assets, not only DeFi, but just the broader growth in the blockchain space. I've been fortunate enough to have known them both from a very early point on their journey, 2018, 2019, when they were really just getting started. And I don't think our industry would really be where it is today without both of them. We're going to talk today about, just kick off the day by talking about where we are with real-world assets. Not necessarily the why, but how we're going to get to meaningful levels of institutional adoption, market penetration, and when it's going to happen. And I really wanted to start with just a quick and very simple poll of the audience. Okay, so today, according to RWA.xyz, there's about $12 billion of assets tokenized on-chain that excludes stablecoins. So this is predominantly treasuries and private credit instruments. At what point do we reach $1 trillion of tokenized assets on-chain? So roughly 100x from where we are today. I want to get a poll from the audience to when. So can you please raise your hand if you think we get to 1 trillion by the end of 2025? Okay, maybe one or two hands. What about by the end of 2026? Okay, a few more hands. What about 2027? Okay, what about, raise your hand if you don't think we get there until 2028 or beyond. Okay, interesting. That's probably the mode outcome. And I find this fascinating because, there's $600 trillion of assets tokenized, there's 600 trillion of assets globally. And we're only talking about 1 trillion of tokenized assets. So that's, that's like 16 bips of the total market. If this technology is so powerful, and we've been working on it for almost a decade now, why have we not made more progress? So I want to kind of connect the dots backwards and start really with the past, focus on the present, and then really look forward to the future. So Stani, Lucas, I think just to start, can you help contextualize your journey in this space, and what have been like the key challenges in solving this problem? Why has it been so incredibly intractable and difficult?
Yeah, you're asking an engineer to talk about problems, so I have to be careful not to get too focused on it, because I love to focus on those. I think we've spent 10 years, yes, but we've also spent 10 years like building from like an extremely basic level, right? Like the technology of Bitcoin is older than 10 years now, but like you really couldn't use crypto until about 5 years ago, I would say. For much, even today, it's still extremely hard to use. So I think like putting it into perspective, for me the time where I would say the clock started ticking in terms of like bringing financial products on chain was when we had the first AMMs, the first kind of lending protocols, and like settlement currencies, i.e. stablecoins, with like at least a little bit of adoption. But like just to give you like one data point, like when you're doing real world assets, you go into the real world, like meaning you on and off ramp crypto quite a bit. In 2020, like when we did the first transactions, like we spent 0.5% to go in and out of USDC DAI into dollars. And that, like, imagine you have to somehow justify that transaction cost to traditional financial institutions. Say, oh yeah, like we're doing it in crypto, but it's going to cost you 0.5% more. So I think, right, like the clock for me started ticking then, because that's really when we had the first viable kind of on-chain ecosystem. And from there, actually, I would say, well, like it's been like unfortunately it followed very quickly by like very negative regulatory and market climate, i.e. like Luna and FTX, that shied away a lot of the like institutional users and probably cost our industry at least 2 years, and we're only really coming out of this now, right? And so I think that's maybe how I think of the last like 10 years, but only really like I'd say the last 5 years that really matter for me.
And I do think that there's a lot of tokenization happening in some indirect ways, and it's been going for quite a while, and I think stablecoins are a great example of that. So obviously, as stablecoins are growing, the more centralized ones, these are backed by not just cash deposits, but also treasuries as well. So there is an element of growth in RWAs through that indirect, through stablecoins. And I do think that the RWAs are really more complex area, and something that is really fascinating in this particular segment of on-chain finance is that it has its complexity also around compliance and also the cost that Lucas also mentioned. So it really depends on what is the underlying asset, the structure, whether it's a fund, region, and all those compliance hurdles. So just to give you a really simple comparison, in a more like a permissionless environment, you're focusing mainly on the technology. So you're focusing on how do you build a secure technology, let's say a protocol, AMM, or a lending protocol. But in the category of RWAs, there is that component of technology and tokenization, but a lot of work actually goes into that compliance and regulatory layer as well, and structuring, and then depending on what the audience is and how wide it is and how much, like how widely you can offer that product further. So I do think that it's a different kind of a beast to navigate, and also at the same time when there's this regulatory uncertainty and what Lucas mentioned, these market cycles as well. So it is a space that kind of like has interesting breakthroughs and kind of like a pushbacks at the same time. So it's a more like a conservative layer of the open finance. But we've seen a lot of breakthroughs here and there, and early signs also. I think we worked with Aave and Centrifuge, our earliest RWA lending market a few years ago already.
21, yeah.
21. So and that was a successful experimentation, but that's something that we didn't go and scale further. And RWA is a space that there's so many things to do at the moment. So and different priorities and trends are changing. And something that was said earlier today about the rate environment, that also is really applicable. So if there is a rate opportunity investor base in decentralized finance that is interested in these assets, that also drives demand, and that demand drives also tokenization. We're just missing kind of like the right structures and layers to actually do it properly. And I think today we're in a better position than let's say a few years ago.
Got it. That's so. It sounds like from a technology standpoint, you see there's being major strides have been made. From a regulatory compliance standpoint, things are kind of, the kinks are getting worked out. It's taken longer than you've expected. From a just like pure demand standpoint, from institutions or on-chain on-chain capital, has there been demand to hold RWAs, or like what are you seeing in the market today from institutions that you've been talking to at Centrifuge, or just on-chain pools of capital? Are you seeing an uptick?
I think like off-chain capital coming on-chain, that's still it's happening, but very slowly, and that's where I think like my opinion 5-year history that we've had was just not long enough yet. The rates changing, what Stani talked about though, did ultimately hugely boost the the attractiveness of RWAs, because what you do have is you do have a lot of on-chain pools of capital, whether that's funds like ParaFi or foundation treasuries, DeFi protocols, individuals that just have had plenty of bad experiences with going off-chain and on-chain all the time and kind of interacting with the legacy banking system. And while, right, like for most of the last couple of years, until about a year and a half ago, right, you made more money putting your dollars into Aave than you would ever make putting it into like any money market fund. Now that kind of actually changed significantly, or at least there's some money to make putting it into a money market fund, and so now actually like people are starting to chase yields, and that is like the biggest driver for demand. And it's actually it's good because when we started, the products we brought on chain were some of the most complicated, hardest to understand products, private credit, and well, of course, because like you had to take some risk to earn some yield if like risk-free rates are zero. So it was a very hard selling proposition to kind of bring these products on chain, especially for a crypto native person that didn't understand these products. Now a treasury bill product is much easier to understand, and okay, it's treasury bills. Your counterparty is the U.S. government, and so buying that is actually much simpler. It's much more liquid, and so I think it actually is it is an easier product to bring on chain, and therefore I think it's also easier, and we're seeing that already. We're seeing a much more mature market around treasury bills, with them getting onboarded as collateral into lending markets. With I think secondary trading is still a bit away, but I would say that's going to happen soon. And it's probably maybe my prediction for this year is that we will actually see secondary liquidity for these assets, and I think that is that is going to create enough of an on-chain critical mass that the traditional financial institutions are actually going to look at it and say, yeah, this is a financial system that we can participate in. It's not just this exotic thing I don't understand, that I don't even believe really exists.
And I think that there was a really interesting uptick on RWAs, and especially the treasury yield on chain last year, and even went through all the beginning of this year. So the interesting thing about the kind of an on-chain liquidity or investor base is that it's really quite mercenary at the moment, and it's very much about an arbitrage of finding where is the highest yield on the same risk category, or maybe a little bit higher risk category. And what we saw this year, that there was more opportunities on chain to get higher yield than RWAs, and now that's kind of a demand that happened over a few months is going down. So what I think might happen actually, that we go to the same direction as we were in last year, where the on-chain rates are a little bit in pair with RWAs, let's say the treasury yields, and then we create more interest into RWAs again, and that can be really a good tailwind. And I think one really probably a significant actually accelerator for RWAs for on-chain liquidity is more of professionally managed treasury managers. So things like, for example, Carpet-Key, that are putting effort on managing DAO treasuries and managing liquidity on chain, where they have more accountability. Their points like diversification comes into play. So one liquidity movement that I'm expecting to happen is that once there's earnings that happen on chain, they will be diversified away from some of these opportunities in DeFi into RWAs. And that's if you have a diverse RWA ecosystem on chain, that will mean that it's very easy to diverse and also apply that kind of strategy for DAOs as well. So that's going to be one interesting play I'm looking forward to.
Yeah, I think a lot of interesting points there. I mean, one thing that stands out is, we've had this headwind. We've been swimming upstream with interest rates where they are. There's tremendous competition for capital, but notwithstanding that, from when we went from a ZIRP environment to a higher rate environment, stablecoins have still grown from 100 billion to 160 billion over that time frame, despite the fact that stablecoins earn 0%. There's still been very meaningful growth. So I want to kind of tap into what pockets of RWAs you're most excited about. You've seen, I think yesterday, BlackRock just announced that they've passed 500 million on BUIDL, their tokenized treasury product. Total tokenized treasury market is listed at 1.8 billion today. You've seen a lot, in the private credit space where Centrifuge has really been the market leader. What are the different categories of tokenized assets that you're most excited about? Kind of what are the pockets of optimism that you're seeing in the market around kind of new innovations in RWAs?
The treasury bills are like the entry-level product. I mean, even in traditional finance, right? Like a lot of these treasury ETFs that all these big asset managers are issuing, they're not really like profit centers. They're really like a basic offering that everyone has to have, and then like the more complicated. Like maybe you go into like a high yield bond product or a real estate fund or like a sector, like, I don't know, pharma tech company ETF, right? And those are the products that are like then where like the complexity comes in, the margins come in for industry. I think the same thing is already happening in T-bills. Like there's hardly anyone making money with tokenizing T-bills themselves. And so I think this will be much more commoditized. And I think actually maybe one interesting thing there that I predict will be very different than in TradFi. Stuff in TradFi is very sticky, and stuff in DeFi is not really sticky at all. I mean, you saw the kind of yield farming wars, the like yield subsidies, the kind of like that were able to vampire attacks Uniswap with SushiSwap. I don't remember the exact numbers right now, but I mean a huge amount of liquidity moved over within, hours, and like that is because it's all programmable, because it can be like programmed to just like fully automate the yield. So I think like actually treasury bills and kind of these very like standard products will be even more commoditized than off-chain, because like I'm still too lazy to do a trade to sell a BlackRock short-term treasury ETF for a Vanguard short-term treasury ETF. But there is definitely a DeFi protocol where I put money in and it'll go to whichever one the cheapest is by the second, right? And so I think that is maybe what we have today and what's going to happen. And I think then from there, like the interesting assets are the assets that ultimately like you can't really build today. So I think it's going to be much more like exotic private credit stuff that, I mean, today is called private credit, but will look a lot more like public credit, meaning like because creating liquidity on chain, because creating lending opportunities for these assets on chain, like they'll actually be able to get a liquid market that they can't get in the traditional system. So I think that's what we're focusing on. I think also a lot of these assets that, I mean, treasury bills, the transaction costs are simple, like the whole infrastructure is relatively well established. In private credit securitizations today, you quite often work with 10 to 20 different service providers. They all receive a spreadsheet of your assets. They do something with it. They tell you what to do then, whether that's like valuing the assets, whether it's calculating interest rates, verifying how much each investor owns, right? And a lot of that can actually be replaced by smart contracts. And that can shave off significant transaction costs. And that's where I think like the kind of more defensible, kind of harder to build real world assets are going to be really interesting in the long term.
I like what you said about it kind of has about the liquidity moving really quickly, and I think it has like pros and cons. In traditional finance, when the liquidity might be more stickier, you might be less eager to compete and shop for yield on a daily basis. And on-chain, things move really quickly, and we've saw with the points meta as well, and we've seen it with these interest rates, liquidity moving from RWAs into the next thing and capturing the opportunity. So that like a fast liquidity movement is interesting because it realizes the opportunity really quickly, and it prices the liquidity itself as accurately as possible in the most transparent way, which is on the blockchain by being auditable by anyone. And that at the same time brings instability. So one thing that is good about the kind of like a TradFi is that as things aren't moving necessarily as fast enough, there's some stability, which can be also seen as inefficiency at the same time. So it might be that we will see these cycles happening in a very quick form, and these opportunities are explored extremely quickly. So it might be that, let's say, private credit might take off, and that's the new interesting category. But once the next thing comes up, a lot of that liquidity will move to the next place. And I think that's going to be the nature of the on-chain liquidity movements, because there's so little friction around it. But I do think that when more of that accountability is coming and the space is getting more and more professionalized, we see more diversification. That's going to be the key. And I think the private credit is, and I do think that a lot of these fund tokenizations will happen at scale, treasury bills, and I think that's going to be a staple, and it's a massive amounts of tokenized TVL. But I'm specifically interested in the private credit because you can actually start funding opportunities that necessarily isn't reachable, and that's like a new business opportunity. So the tokenization part is basically taking something from an old system that is inefficient, complex, has bottlenecks, and putting it into a new system. But being able to use this system in a way that you actually empower new business opportunities, create new entrepreneurs, create new, for example, cities and towns, and can fund even nations at some point. That's going to be like a really exciting path over the long term. So I think private credit can work in a way where it can be all issued anywhere, and then there's a backbone market on chain that is happening, and the trading is happening on an ongoing basis transparently, and bringing new opportunities. I think that's something I'm looking forward to as well.
All right, so zooming out just more broadly for a second, how coupled and correlated is the success of tokenization of real-world assets to just the broader crypto space? Like the price of Bitcoin, the price of Ethereum, does that matter? Are we on is this category on an island? You talked a bit about, interest rates and, competition for yield, and let's put that aside for a second, because I think we can agree that impacts this category. But do you kind of think about this as like a secular, uncorrelated pocket within the broader digital asset space?
I think it's all still correlated. So if Bitcoin goes to zero today, I'm pretty sure we're all upset, even if we're bullish on RWAs, and maybe we're less eager about the space. But at the same time, a lot of folks here are for the technology, and regardless understand the implications of actually what tokenizations can do and what the blockchain can enable at the same time. So there's a little bit of kind of like its own category that is growing, and I kind of I feel I'm a person who is so I used to follow always on a daily basis things like DeFi Llama and seeing like how different protocols are earning revenue and what are the different yields. Now I'm kind of in between. I'm watching the RWA XYZ and DeFi Llama, and then there's people who are just watching and following the RWA dashboard. So I do think like they kind of are a little bit separate even in the on-chain context, but it's a broader category is still the same until they can grow a bit more apart.
I mean, I would say the minute they're completely uncorrelated as any financial product is from another one, we've made it, I would say, because that would be the indicator that it's not crypto users using real-world assets. It's that like just everyone is using real-world assets, right? Because yeah, like today the largest holders of RWAs are DeFi protocols, crypto funds, and crypto like companies that raise money, and they're all, of course, some getting their cash from crypto and indirectly or directly. And so I do think, yeah, like they're getting a bit more uncorrelated. In a way, real-world assets are a bit anti-cyclical actually to crypto, because like when prices go down, people flee into stable assets. And that is definitely something that's happening when like the market becomes super bullish, which was happened like earlier this year, right? Like everyone went into Athena instead of tokenized T-bills. And so I think that is happening, but in the end, right, like even RWAs today are like really dependent on the crypto users. Now I think that is going to change, but not yet.
And so as you guys look into the future, at the kind of the shape of the growth curve in this category, what do you see? Do you view kind of this, like this category as being one that like steadily compounds over time, more assets move on chain, there's almost like, very high, like, but linear growth? Or do you view there as being kind of a critical kink in the growth curve where there's almost an inflection point and you see a bunch of adoption, very suddenly? So you almost have this gradually and then suddenly phenomenon that, maybe we've seen in other areas of technology, AI being a great example of, many, many years of research and billions of dollars, being invested in that category. All of a sudden we wake up, we have ChatGPT, fastest product in history to 100 million users. Is this a category where we're going to wake up one day and like experience just tremendous exponential growth, or is this, more of a, a linear compounder?
I can have a couple thoughts on that. So I actually think RWAs can really be the thing that actually leads the on-chain finance, and mainly because like the aspect of tokenization, because obviously there's already established financial system where we have funds, we have different kinds of financial instruments, and tokenizing assets from a technical perspective is not a big challenging operation, and obviously it has a lot of other layers that are interesting. But once there is a bigger initiative or a bigger, let's say, asset manager that wants to tokenize most of their assets, and that behavior will replicate, that actually that will create big spikes. And at that point, we can, if we see multiple banks and financial institutions doing that, it sends a big signal. And when you have something like that, that might actually change the paradigm completely. So in some sense, that DeFi has grown actually quite a lot, even at this market cycle. We've had since today we have 20 billion net deposits in the Aave protocol across all the markets, and 10 billion of that came since the beginning of the year. But that doesn't like sound. It's a little bit unseen at the moment. But the moment a financial institution is starting to double down on RWAs, and what we've seen, for example, with BlackRock's Biddle fund reaching $500 million already, and once they, start to actually accelerate this, and we see multiple competitors doing the same, that actually can send a really big global signal. And we already met a lot of institutions at this point that are super excited about tokenizations, RWAs, and are looking to do something in the space. So I do think there might be that kind of like brute force moment for RWAs, and that will just drag the whole DeFi space. So DeFi from 2-3 years from now might look completely different than it's looking today, actually.
Yeah, just to kind of add what I'm seeing, it's very similar. We're very focused at ParaFi on, we've met with hundreds of founders in the real world asset space. We've talked to many institutions exploring this as a technology, and we are seeing exponential growth in terms of the teams building and the institutional interest in this category. I mean, BlackRock is the most visible and vocal one. You've seen Larry Fink say that tokenization is the biggest unlock in capital markets since we went from analog to digital in the 1970s and 80s when we went to kind of electronic record keeping. And the treasury product is really just the tip of the iceberg. They're planning on tokenizing a wide range of different products, their alternatives, business, et cetera. You've seen KKR tokenize an LP stake in one of its private equity funds. Hamilton Lane do the same. You're seeing a lot in tokenized repo. There's just a lot of activity happening in the space, and it feels like that is very much like a leading indicator for what you'll see on chain, which lags just ever so slightly. But Lucas, what are your views on this?
I think, yeah, I mean, 2 or 3 years from now, DeFi will be fundamentally different, and I think the impressive thing about BlackRock is exactly that it's actually using DeFi, right? Like the difference between, I think, the transactions we've seen at KKR, I think, was maybe 2 years ago, and BlackRock today is that BitL is intended to be used in DeFi. Now, of course, like there's a lot of work to do this in a compliant way, and this is like a lot of what we're spending our effort, our engineering, and kind of other and legal resources on is actually figuring out how to do that. But I think this is like the biggest kind of the reason why BlackRock is different. It's actually not that they're, I mean, sure, it helps that they're the largest asset manager in the world, but it's also that they're actually kind of had this very clear focus on going after the crypto native users that are using DeFi. And I think that is gonna, it creates network effects that many of the large institutional products in the past completely lacked because they kind of were like proof of concepts that existed in isolation, one-time transactions that weren't really sustainable or like gave room to build something in the long term. Or they were like just so locked down that like you couldn't really benefit from actually this thing being a token much. And so I think that is like the place where we focus now is like, yeah, like you want to make sure that like DeFi is going to be used for this and can be used, and that DeFi users or that the institutions become DeFi users through that. And I think like that's the biggest opportunity today.
That's really interesting. Look, I think we're up on time. I'm going to ask one final rapid fire question. The same question I asked to the group at the beginning. At what point do we reach 1 trillion of tokenized real world assets on chain?
I like that there was one guy in the audience that basically raised a hand for the 2025. So basically I don't want this person to feel alone, so I'm going to join that. I'm going to join that group. So I'm bullish on DeFi and RWAs.
I think there's so many things that are kind of out of everyone's control, like whether it's U.S. politics, regulation, another like black swan events, which we have too many in crypto, like FTX, that could slow things down. So for me, it's really hard. I think next 5 years, whether it's 2 years or 5 years, I would not know where to put my money.
I want to say one thing, though. I do think that the kind of open finance space in general, like in DeFi, it is going to be a slow game. Like we're going to see some rapid movements with the tokenization, but seeing like DeFi being the base layer of all finance, that is going to be like a decade-long game, because finance is fragile and it needs to be mature before it can be adopted. So I do think we're still far from that, but we're going to see some interesting things happening in the next months and years to come.
Lucas, Stani, thank you so much. This was
Thank you.
excellent. Round of applause for these two. Thanks.